Welcome to the Deep Dive. We're here to help you get informed, fast. And this conversation, it's part of the Journey series by ACE. They're a cross-border boutique investment bank focused on connecting investors and business owners globally. Today, we're tackling something crucial, navigating the world of investment partners, especially for you, the business owner, maybe looking to grow or, thinking about an exit. Our guide for this is ACE Navigator, really packed with practical insights.
That's right. And our goal today is pretty straightforward. Help you bridge those common knowledge gaps that pop up when you first start thinking about investors. We want you to see it less as this scary negotiation and more like, well, an exciting journey, really. Finding the right co-pilot for your business.
Okay, so let's start right there. ACE Navigator really zeroes in on those early thoughts, those anxieties business owners often have. And they feel very real. Things like, investors went to my competitor, why not me? Or maybe feeling desperate, like, look, I'll sell to anyone who makes an offer.
Yeah, we hear that.
Or the frustration of silence. Send out feelers, talk to people, nothing back. Sometimes it's a tough spot. The company's losing money. I can't manage it alone. I need an investor.
Right.
Or even, my parents built this, but I'm just not feeling it anymore. Need someone else to take the reins.
And look, those feelings, those gaps in understanding, they're completely normal if you're new to this whole investment game. It's a different world. But getting your head around it, addressing those gaps, that's how you avoid messing up a potentially great deal, a deal that could seriously take your company and you to the next level. The message from ACE Navigator here is honestly pretty reassuring. Don't worry if the right investor exists. They do. The fascinating thing is both sides of a good deal are often already out there looking. It's about making that connection. It really is about discovery and, that human element.
That's a powerful way to think about it. Capital needs you too. Changes the whole feeling. Okay, so if we've kind of navigated those initial worries, let's flip the coin. Let's look at the investors themselves. What drives them? How do they break down?
Well, fundamentally, investors are looking to deploy their funds into promising private businesses. Simple as that. They want the best strategies, obviously, to get the highest return on that investment. And how they do that often depends on where your company is in its life cycle.
Okay, so stage matters.
Hugely. At the very early stage, think pre-seed, seed, maybe even pre-revenue, you're often relying on family and friends. Maybe angel investors, individuals investing their own cash. Or incubator funds. Support here is often driven by belief, maybe personal ties, less about hard numbers sometimes.
Right, more relationship-driven at the start.
Exactly. Then, as you grow, maybe hit consistent revenue, you move into that late, early, or middle stage. Now you're attracting different players. This is where venture capital or VC funds often come in. They're looking for high growth, often in tech, taking bigger risks for potentially bigger payouts.
Okay.
Then you have private equity, PE funds. They tend to focus on more established businesses, looking to optimize and grow them for a future sale. You'll also see strategic investors here, maybe companies in your industry and family offices.
Got it. And for the really mature companies.
Right, the late stage.
Yeah.
Stable growth, maybe looking for a big leap or an exit. Here you see the bigger PE funds, strategics again, large VCs, more sophisticated family offices, even sovereign wealth funds. And this is also where an IPO, going public, becomes a real possibility. A key piece of advice from the source here is crucial. Partner with investors who genuinely get you and your business, who appreciate its value.
That ties back to what you said, capital needs you.
Precisely. It gives you leverage, knowing your worth.
Okay, so stage is one dimension. Then there's sector and geography, right? How does that play out?
Absolutely. Investors often specialize. Some are sector agnostic. They'll invest anywhere if the deal looks good. Others are highly sector focused. Maybe only software or only biotech or even narrower, like only generative AI within tech.
Does that focus make a difference?
Often, yes. The thinking is that deep sector knowledge, the experience, the network, can create more value for your company. They bring more than just cash. They bring relevant expertise.
Makes sense. And geography, domestic versus international.
Yeah, that's another big one. Some investors stick to their home country. Some focus on a region like Western Europe or Southeast Asia, and others are truly global. Now, cross-border deals, they add complexity. You've got distance, potential language barriers, different business cultures, definitely different legal and tax rules.
Sounds challenging.
It can be.
Right.
Which is why knowing that investment team really well, making sure you share core values, becomes even more critical when you're dealing across borders. You need that trust.
Okay, that's clear. Now, within all these types, ACE Navigator really highlights two key categories: strategic versus financial investors. What's the core difference there?
Yeah, this is a fundamental distinction. Strategic investors are usually companies already operating in your sector or a related one. They're not just investing for a financial return. They're looking for, well, strategic synergy. How can your business help their existing business? Maybe integration, market access, even taking out a competitor.
So they might want more control.
Often, yes. They frequently prefer majority or full ownership. They're playing a longer game, focused on how your piece fits into their larger puzzle.
Okay, and financial investors.
Financial investors, like most VCs and PE funds, are primarily driven by, you guessed it, financial returns. They want to invest, grow the value of their stake, and then exit. They typically take minority positions, so they won't own the whole company, but they will demand certain rights.
Like what?
Things like a seat on the board, maybe a say in key decisions, often a key man clause, making sure you, the founder, perhaps stick around. And critically, they need a clear path to exit their investment, usually in 5-7 years. This could be selling their shares to another investor or maybe an IPO.
Right, the exit strategy is built in from the start.
Absolutely. They'll often ask for things like tag-along and drag-along rights to facilitate that exit. You really need to understand what those mean for you.
Good point. Any other types mentioned?
Briefly, yeah. Family businesses or family offices, very diverse, can range from small holdings to huge, sophisticated operations. Their approach really depends on the family's specific goals and structure. And sovereign wealth funds, state-owned funds investing nationally accumulated wealth, often with strategic long-term goals. The overall advice, look for legacy investors, partners who will genuinely boost your growth and enhance your wealth long-term. And watch the trend. Lots of investors are crossing these traditional lines now, investing across stages, sectors, geographies, looking for value wherever it might be.
Wow, okay. That's a lot to take in about the investor landscape. So, turning back to you, the business owner, how do you actually approach these investors effectively? Ace Navigator acknowledges it's not always easy jargon, maybe a cold culture sometimes, distance brokers, but it gives us some solid tips.
It does. The first one is maybe the most human. Try to find investors who are, accessible, open, warm even, people you feel you can build a relationship with. The guy is pretty blunt. If an investor seems rude, is super slow, doesn't share info well, or the process feels inconsistent, just move on. Don't waste your time. Trust your gut.
Okay, solid advice. What else?
Right, some key practical things. First, transparency. Cannot stress this enough. Don't hide important information. Investors will do their due diligence, DD. They'll dig into your financials, legal stuff, commercial viability, everything. It's their job.
So hiding something is just pointless.
Worse than pointless. It destroys trust instantly, kills the deal. Be prepared to be an open book. They expect it. Second, get your information flow sorted. That means having a solid business plan and maybe an investment memo. Seriously, don't just wander into meetings unprepared. You need a clear story, a clear investment thesis that shows how their money will grow with your company. Make it easy for them to understand the opportunity.
Like having your map ready before you ask someone to join the journey.
Exactly. A lot of good companies get passed over simply because their story wasn't well presented.
Okay, preparedness is key. What about timing? This process isn't instant, right?
Definitely not. That's the third point. Trust the process. Pace yourself. It's gradual. Information goes back and forth. Milestones are hit. Don't expect cash after one meeting. But also, don't wait forever for someone who's dragging their feet with no clear reason or commitment. Find that balance. Keep things moving.
Right. Manage expectations, but also don't let things stall indefinitely.
Precisely. And that brings us to maybe the most crucial factor of all.
Which is?
People to people. At the end of the day, all the numbers and strategies matter, but successful deals, they hinge on strong, simple human relationships. We've all seen deals that look perfect on paper fall apart because the people just didn't click, no trust.
And maybe deals that weren't perfect getting done because the relationship was strong.
Absolutely. That mutual respect, that shared vision between you and the investment team, that's often the secret sauce. It's the real driver behind getting a deal closed. You're choosing partners, not just funders.
That's such a vital point. So, wrapping up, it's about understanding the diverse investor world, yes, but also meticulous preparation on your side, and never underestimating that human connection. Gaining that knowledge quickly, thoroughly, and then applying it.
Exactly. And maybe the thought to leave you with is this. The best investment deals aren't just about money changing hands. They're the start of real partnerships. Partnerships built on respect, shared goals, ones that ideally last and grow far beyond that initial agreement. It's about building something meaningful together.
A powerful note to end on. Thank you for diving deep with us today. We really hope these insights help you navigate your own investment journey with more confidence.